Hello everybody, this is Eddie Ghabour, owner of Key Advisors Group. Please subscribe to our YouTube channel for up-to-date videos as well as our market opinions on the economy and strategically some of the things that we're doing for clients that hopefully you'll find educational that you can apply to your own personal portfolio. So I'm shooting this video on August the 17th. I was just on Fox Business giving my point of view on the economy and the direction that things are going in. And there's a real debate right now, and this always happens in a bear market when you have a big rally. And make no mistake, this has been a very sizable rally that we've seen. So the question now is, have we changed our opinion to now sway more towards a bullish stance, or are we continuing to stay bearish because of the data that we're looking at? I want to make one thing crystal clear. For those of you that know me personally, you know that I'm not going to BS anyone when it comes to their money. And so I'm not just going to stick to a narrative to try to ultimately be proven right, because there's been plenty of times in this business, if you've done this long enough, that you're going to be right and you're going to be wrong. And the key is when you find out that you're wrong, you need to quickly pivot and not be hard-headed. Now, with all that being said, we are not changing our opinion, because at this point in time, the data that we look at is not supporting that we are wrong. And in our opinion, it is supporting that this is a bear market bounce. Now, of course, this is our opinion based on the data that we look at. You're entitled to your own opinion and do whatever you think is best for your capital. So let's take a step back and let's look at some of the things that we're looking at. First off, there are many different investment strategies, and there's a lot of really talented individuals out there, and everyone has their own way of investing assets. One of the key things that we look at is what type of economic cycle that we're going into. And there's very few times in history where, in our opinion, you need to be very, very cautious and have risk management as the number one thing on your mind. And we are in that period of time, and we've been in that period of time, and we've been talking about this since last December. And the reason why we don't think we're out of the woods yet are for several reasons. But let's start with the Fed first, okay? Because everyone is really spending so much time trying to figure out whether the Fed is going to be dovish or whether the Fed is going to be hawkish, whether we have a soft landing or a hard landing, okay? If you're in the camp that we're not going into a recession and that we're going to have a soft landing, then you should be bullish right now, okay? There's a lot of momentum in the market. I'm not saying you should buy today, but the bottom line is, if that is your opinion, and if that's what your data is telling you or how you're interpreting that data, then buying the dip is going to work extremely well for you if that's the case. If you in our camp, in which we're going into a hard landing, and we are going into a recession, then I think you have to be very, very careful where we are right now, especially if risk management's important to you. So let's go back to the Fed. One of the biggest things that investors need to understand is how the money flow works and how much our economy and businesses rely on credit, and borrowing money. A lot of businesses need that capital to run things. Governments need that. The liquidity system needs that, okay? And right now, the Fed is getting ready to embark on a strategy that they've never done before in regards to how aggressive they're tightening. They've already raised rates probably more aggressively than they should, and we haven't seen the results of that yet. Let's keep in mind, these rate hikes that they're doing can take months until it goes and reflects economic data or the price of assets. But let's now focus on the balance sheet. I think this is a bigger deal than rate hikes. They are going to attempt to let $95 billion a month roll off of their balance sheet. So let's put this in perspective. Last year, they were buying over $100 billion of bonds to keep liquidity in the system and to prop things up. So if buying $100+ billion of bonds did its job in keeping asset prices up, what should ultimately happen if they do the opposite? And that $95 billion is a huge number. And they're supposed to be doing that in the next couple of weeks. Now, we have to wait and see if they actually do it, okay? Because they were supposed to be doing $47 billion a month, and it looks like when we look at the Fed balance sheet that they haven't actually done that. So it's not just listening to their words, it's seeing the actions that they're going to actually do. But during that last Fed meeting, Chairman Powell did say that they plan to stick to that $95 billion number. That's a massive amount of money coming out of the system. You couple that with rate hikes, and you're now looking at the fastest tightening cycle the Fed has ever attempted to do in history of monetary policy. When you tighten that fast, when we're in an inflationary environment that has the consumer struggling, and we can tell the consumer is struggling just by looking at the credit card debt and where they're spending money. All you have to do is dissect these earnings from retailers. The consumer is buying essentials. They are cutting back on discretionary items that they don't necessarily need, and that's why inventories are piling up on these retail companies. And the Fed thinks that it's okay to tighten that fast by letting $95 billion roll off, maybe raising rates by 50 to 75 basis points in September, and raising rates potentially in October and December. That's not a gamble I'm willing to take, and this is why we find the probability, which is what we make all of our investment decisions off of, the probability of a soft landing, if they actually stick to that, we think is very, very low. And time will tell in regards to that, because again, I can't stress this enough. The moves the Fed are doing and have been doing are not fully priced in, and we haven't seen the effects of it yet. And right now, with this big bear market bounce that we have had, or at least what we believe is a bear market bounce, they are pricing this to perfection in the sense that they are betting that the Fed is going to have a soft landing. And again, we are just not in that camp. I think it's a very dangerous experiment that they are trying, but they're going to do it. At the end of the day, there is no right answer to this because of the amount of money that we have borrowed. There is no free lunch. When you borrow and spend the way that we have, the de-risking process and the deleveraging process that comes through with that is extremely painful. I just don't see how we only get a bear market for 8 months when we're coming off of one of the largest bubbles in history. Again, time will tell in regards to that. So let's stay focused on credit, but let's go away from the Fed now and let's look at these financial institutions, okay? With the housing market starting to crack, and we think we could be going into a housing recession, obviously one of the things that buyers need are lenders to lend them money. And because of the economic slowdown, we are finding that financial institutions are tightening up their credit standards. They are making it harder to borrow money. Not only are they making it harder to borrow money, but the rate at which you are borrowing money for businesses and individuals have gone up quite a bit on a percentage basis from just a year ago. So not only do you have the Fed taking liquidity out of the system, but you have our financial institutions trying to protect their balance sheets, which I don't blame them for that. But in regards to that, they have to tighten up their lending standards, which means there's less money to circulate to consumers who need it, as well as to businesses. And like it or not, this entire financial system needs credit, needs liquidity, and we are taking it out of the system at one of the worst times you possibly can, which is during an economic slowdown. So when we take a look at what the Fed is doing, and we look at what financial institutions are doing, it is a perfect storm of liquidity getting sucked out of the system at the worst possible time. And let's touch on one more thing with the Fed before I move on. There's also the bull case that the Fed is going to be dovish and they're going to cut rates at the beginning of next year. Okay, now let's think about this logically. Is the Fed going to cut interest rates because the economy is booming and the market is booming? Or are they going to cut rates when we are in big trouble and we need a backstop to the bleeding? So I would actually argue that if you are of the opinion that the Fed is going to cut rates in the first half of next year, then you must be in the camp that we are going to have a hard landing that requires the Fed to bail us out, okay? Because again, if you're bullish and think the economy is going to have a soft landing and the market's going to hit new highs, why would we need the Fed to cut rates? Doesn't make sense, doesn't pass the sniff test. So I discount that in regards to not being a bullish sentiment, but actually being bearish if your entire bullish case is that the Fed is going to pivot. The other things that we're looking at again is housing is weakening. Consumer confidence is at levels we haven't seen since the 90s. Home builder sentiment plummeted in this last report. Redfin has come out with data showing the percentage of new construction homes that are being backed out of and canceled in regards to new home buyers canceling their deals are really starting to increase as well too. So the writing is on the wall, and when you couple that with CEO confidence that have plummeted, small business confidence that have plummeted, all these data points, when you connect the dots, coupled with what I just laid out on what the Fed is doing and what our financial system is going through right now, is why I cannot change my opinion. I have a fiduciary responsibility to my clients to try to protect their capital as best as I can with the information that I have at my disposal. And right now, there are more things, in my opinion, that can go wrong than can go right. So I'm not going to get out in front of this freight train of experiment. Now, let me express this. I hope the Fed can navigate a soft landing, because a hard landing is not good for anyone. But again, I have to base my decisions based on the probabilities of that happening. So what's going to come from all this is I believe that if we are correct in regards to our assessment that this economy is going to continue to decelerate and GDP is going to weaken over the next 2 quarters at a minimum, in our opinion, that what's going to ultimately come from this is some of the best buying opportunities that our clients haven't seen in a long, long time. So right now, our game plan is to be defensive. We are not 100% cash, but we have a tremendous amount of cash set aside for our clients to be opportunistic. If we're wrong, we will have to deploy that capital sooner and pivot. If we are right, we are going to have opportunities that hopefully will not only help our clients grow their wealth tremendously over the coming years, but leave an amazing legacy to their kids and grandkids. So make no mistake about it. This is one of the most challenging markets in history to try to decipher, because there are so many things that could go wrong or could go right. And I will end it with this. We are a global economy today. And again, whether we like it or not, what happens overseas does impact us here because of the amount of multinational corporations we have. When you look around the globe and you look at Europe and you look at Canada and other parts of the world, they are getting hammered with inflation. And it looks like they are heading into a recession as well too. And so we could potentially be heading into a global recession in the coming months. That at that point in time, we would need the Fed to step in to try to backstop the bleeding. But if that happens, you would have wanted to put your capital to work before we got to that inflection point. So these next few months are going to be extremely critical. We have Jackson Hole at the end of this month, and my opinion is they're going to do damage control, because the last thing they want to do is have the market misinterpret what they said and have asset prices go through the roof again. That's what they're trying to protect against. We have the Fed meeting in September, as well as the rolling of the balance sheets. And then lastly, that we have coming up are earnings revisions. We think earnings are going to get revised down again. So these next few months, in our opinion, will be extremely volatile and extremely important in trying to figure out who is right and who is wrong about this economy. And whether you're right or wrong, whoever you are as an investor, you can't be hard-headed. You have to pivot with what the data is telling you. So I hope you found this video valuable. I probably spent more time than I was planning to today, but I wanted to take this opportunity to try to educate investors out there. So that way you can look at what we're looking at and compare that to other things that you look at as a resource. You should have multiple resources when you're making a decision in regards to how to invest your family's hard-earned capital. So with that being said, have a great day, and I hope you make this a winning week.